Hello everyone, it's Shea at the LifeWealth Group. I'm here to give you your weekly market update, and as you can tell, the roller coaster continues. We saw on Friday a small surge in the markets. They were quick to rally around a statement by Federal Reserve Chairman Jerome Powell that bigger interest rate hikes were not being discussed at this time. However, it was short-lived, and by Monday we saw the indexes, the S&P 500 and the Nasdaq, post their longest weekly losing streaks in over a decade. By Monday, the S&P and the tech-heavy Nasdaq had fallen 16.2% and over 25% respectively so far this year, with growth stocks taking a hit on concerns that the interest rate hikes could hurt their future profits. So we are anticipating a slowdown, of course, in growth stocks for that reason. And traders appear to grow increasingly more skeptical that the Federal Reserve will not be able to achieve a soft landing for the economy by raising rates enough to tame inflation without causing a recession. So the feeling still is, can the Feds do enough quick enough without triggering us into a recession? And the longer we go through this, the more skeptical people are getting about it. It's a bit of a song and dance for the Feds, really, because they don't want to tip us into a recession. And so they're trying to pace the way they're raising interest rates to keep that from happening. They're treading a really fine line. Also, fears were further confirmed by Wednesday's inflation data. Inflation numbers didn't fall back quite as far as we'd hoped from March's pace. In March, it was 8.5%. We were hoping to see it around 8.1%, and in fact, it was just posted. It only fell as far as 8.3%, so higher than we want to see. The efforts that the Feds have made so far seems to have had little impact on inflation. Prices continue to increase rather than slow down, so we still need to see that come into effect. Fears that the economy could head into a recession were further exasperated. You're listening to the news and you're hearing about the conflict in the Ukraine. We're hearing about supply chain issues and also the latest pandemic in China. These all play into what we're seeing and into the numbers that we're seeing issued here this week. However, there are factors that could lead us to believe that a recession is not imminent. In fact, with all the talk of a recession, the chances are it's possible it could be more self-fulfilling prophecy that we're more afraid of. And here's why. Typically, if we're headed into a recession, one of the leading indicators to that is the fact that employment numbers are down. People don't have jobs to go to. Wages go down. We're seeing the opposite. Wages are increasing. There's quite a demand on the labor force right now. People are changing jobs for higher wages. Wages is very competitive. There's not enough employees for the positions that are available. These are not indicators that typically would take us into a recession. Also, we still have a lot of liquidity in the market. If we want to tame down a recession, you've got to cool off the liquidity. That's a move the Feds could make, but highly unlikely is that they would. They've never done this since the Great Depression. They tend to just try to use the interest rates. But people still have money in the bank, money to spend. Savings are very strong. They're at very high levels. People are not leveraged with debt the way they used to be. Families are better equipped, in fact, to weather the storm that we're in right now. This is very unlike 2008. Most of you can remember people were leveraged with mortgages, 2 and 3 homes, all mortgaged. They didn't have the savings. They were losing their jobs and they couldn't cushion the loss and had to default on their mortgage payments. It's a very different situation today. People have learned their lesson and they do have significant cash reserves on hand. So it seems to me that they're weathering it a little bit better than we ever saw in 2008. Right now, the focus is on the release of the sales report that's due out anytime now. It'll be interesting to see quarterly earnings on some of the big companies, retails out there, Walmart, Target, Home Depot, all the ones we shop at. This will be another indicator on what's happening with inflation and if any pressure is taking effect right there. On a positive note, everyone, I thought you might be interested to hear that there is actually one industry that's been doing well through all of this. And would you believe it? It's the US gambling industry. They've reported a 5.3 billion in revenues for the month of March. And according to a report from the American Gaming Association, it was the best month ever. Just thought in the midst of not so great news, somebody out there might like to hear that. On the front of what we're doing, look, how long will this last? How deep will it go? Well, we don't quite know that, but what we do know is we planned ahead for it so that we would be prepared. So for those of you who have been with us for a while, you know that your plan's in place. But we do realize that there are opportunities to be had in every environment. So we're always on the lookout for what some of those opportunities are in this environment. And one of those is, as we continue to monitor, we're seeing opportunity with dividend paying stocks. There is a little bit of wisdom in the principle of get paid while you wait. So good companies with good history of paying their dividends, it acts like a little bit of income while you're waiting for growth to kick back in. So that's one strategy we're looking at. Another one is looking at opportunities. There is always somebody that does good in this environment. Things like infrastructure and energy are doing really good. Utility stocks tend to do quite well in an environment where every other environment's been hit, because they tend to be defensive. I mean, people need electricity, they need food. So those kind of defensive stocks tend to do well. So we have a portfolio called our Unique Possibility Portfolio. It looks at different themes or areas that are industries that are doing well, and it picks to allocate there. We're also seeing that value stocks are underweighted. We've been so heavily focused on growth that we're seeing some opportunities possibly in value stocks. With that said, I just want to bring up once again, when the markets go down and the value of your accounts down, it can be, for some people, it's a good time to do a Roth conversion. You switch over to the Roth while your account is lower and it's cheaper to convert. And when you get into the Roth environment, you grow your accounts back up there tax-free. So these are just a few of the opportunities we're seeing. We're in discussions with some of our money managers, and as that becomes clearer to us, we will bring that to you. In the meantime, if you have any concerns you want to talk to us, just give us a call. We'll do a quick 15-minute review of your plan, where you're at, just remind you of how you're set up to weather this. You can schedule online as well at the LifeWealthGroup.com, and you can also check out emails for upcoming webinars. If you've got friends you want to forward this email to, that would be greatly appreciated, and you will hear from us again shortly. Thank you, everyone.